Hello, good afternoon, merhaba. I'm Nilgün Şimşek. As a moderator of this session, I'm very pleased and privileged to host these three valuable guest speakers and of course expert at this stage. Thank you very much and welcome back again. Teşekkür ederim. We are here to discuss risk and opportunities in Central Eastern Europe region, considering market dynamics and changing environment. Obviously, if we talk about the changes, it's quite familiar things to us nowadays. Everything's, all balances changing in the world continuously. Every week, especially, we are focusing on different topics or issues, let me say, different than the previous week that we focused. Let me say, for example, lately we were speaking about the climate changes, geopolitical changes, or what can I say more, technological, fast evolving technologies. But lately, what's happened, trade war topics has been added on top of everything. Right now, all governors, central banks, politicians, all relevant people try to understand the situation to take action further. Like us, asset managers, we do the same. We digest all information, all news that we receive, and accordingly we take action. For what? To protect the stakeholders and clients' benefit. Dynamism is everywhere. Of course, uncertainty is everywhere as well. Every year is becoming very difficult for asset managers to navigate the portfolios and to manage the client expectations. But I think this year is much more difficult than the previous years. But the two good things, we cannot think only one way. There are always pros and cons in the market. So today I have prepared a couple of questions to ask our experts to understand what is the risk and opportunities, especially in Central Eastern Europe region. So welcome again. Burak, if you want, let me start with you first of all. My glasses. We are experiencing very big challenge and changes in the global trade environment and supply chain. After announcement of new trade tariffs, lots of countries, as far as I know, expected growth rate has been changed. There was lots of issues has been aroused, especially in April. World Economic Outlook report has been issued and it's downgraded some countries, big countries, expected growth rate downward. So how this protectionism will affect developed and EM markets? What type of opportunities you're seeing in these markets going forward?
Thank you very much, Nilgün, and thank you again for this kind and informative, really, introduction. So before, or in order to answer your first question, in my view, we have to elaborate two more questions. First, how will this trade war or trade dispute will last? Is it going to end? This is one thing we have to understand. And the second second question for elaboration is, how will the counterparties, parties to this dispute, especially US, China, and the other blocs, regions, or individual countries, will react? Will they continuously retaliate or will they negotiate? So by the end of March or beginning of April, we started with high tensions between US and nearly rest of the world and primarily with China. Then suddenly we entered in a truce period, a 3 months truce period. And nowadays we are hearing that US and China is still, they are talking, they are negotiating. United Kingdom and US seems that they have a deal at the moment, but on the contrary, just recently we saw that again tensions aroused between European Union and United States. And even imminently, just in 1 or 2 days, the tensions diminished, and again a truce period started. So this means basically uncertainty. The volatility is not stemming from the markets itself, from the macroeconomic numbers itself, but it's stemming from politics, international politics, trade war, trade deficit. The main reason is the trade deficit, budget deficit, basically of the US. But this volatility creates uncertainty, and uncertainty is not easy to compute, is not easy to price. We see the results everywhere in the markets. We see it on the price of the precious metals. We see it on the yields of the bonds, on the exchanges, etc. We are living through it. And this uncertainty also directly affecting not only the developed markets, US, Europe, but the rest of the world, including our region, CEE, Middle East, and Turkey, of course, staying right in the middle of everywhere. And this it is affecting the markets and the behavior of the participants two ways. First of all, the investment sentiment is deteriorating because of this uncertainty creating volatility, and on the other side, it's also affecting the behavior of the households. It is really important for consumption and very important for economic growth forecasts. So people cannot decide on what to spend, how to spend, when to spend exactly. This is the situation at the moment as market dynamics. And the countries, if you come back to our region, CEE region in discussion, and including the Middle East maybe, the countries that have higher shares of international trade with US, or countries that have trade surpluses to US through their exports, they are the most they will be the most negatively affected ones. We are seeing through it. But on the contrary, the countries who have less trade volumes, insignificant trade volumes with the US, and maybe trade deficits to the US rather than surpluses, might be in a relatively immune position. When I look at through the region, I can say that maybe Poland, Hungary, Czechia, even Turkey seems in a somewhat relatively better position. Turkey has a zero balance with US, and there's not a surplus or deficit in the trade volume. On the contrary, Turkey has a trade deficit, a huge trade deficit with China. And the opportunity side is, I believe, will be coming from for those countries who are in this position I described. That's the point at the moment. We can stay here and see what will happen, and we are hoping that all these negotiations will end in a sustainable equilibrium. Other than that, we will see much more volatility in the market.
Definitely. Thank you. Thank you very much. Mr. Toni Iivonen, next question is for you. What are the major economic risk factors you're expecting for this year, for 2025? And how do you evaluate the effect of inflation, rates, and geopolitical uncertainties on capital markets? And what will be the opportunities for investors?
Thanks for the question, Nilgün. Of course, it's a very broad topic, but I guess, so in my mind, it boils down to one thing. So you have to understand the psychology of Mr. Trump. So I'll give you an example. For example, if you look at the first term of Mr. Trump, so he was elected first time as the president of the US in 2017. You look at market action, headlines, anything in 2018. So back then it was also mostly a discussion about like trade tariffs with China and the EU and every other country. So in the end, what happened? So 2018, 2019 were a little bit volatile years. Then the US had like midterm elections, and after that, let's say markets, even though there was COVID and so on, the markets, especially in the US, performed quite well. So my base case, let's say, expectation is that this will pan out more or less the same as his last term. The second thing is that you kind of like have to have some kind of like longer term view or like understanding of what he's trying to achieve. So for example, with regards to trade tariffs, so I was actually in New York a couple of weeks back, and I had the pleasure to listen to Mr. Robert E. Lighthizer speak about trade tariffs. So he used to be the US trade representative for Trump's first term cabinet. So basically he advised Mr. Trump on trade policies. So what he said was basically that what Trump wants is bilateral tariffs on the same level. So if you look at effective tariffs in the US, so it's basically about 2.5%, 2.7% on all imports. When you look at the main trade partners like China and the EU and so on, so that import tariffs for US goods range from like 10 to 30%. So what he wants probably is, so my expectation is that they should be, if you want to import stuff to the US, so it should be 10%, or if you go to EU, it's 10%, so like on the same level. What else? So basically it's also, so as you've seen, so the market has been quite volatile this year. It's mostly because of like, let's say Trump comes up with some kind of idea that now we put trade tariffs at like 130% or 50% or whatever. And there's actually somebody, Financial Times writer actually coined this new term that it's called the takeout trade. So Trump always chickens out. So this is what has happened basically so far. So if there's some volatility, I see that as a buying opportunity, and when kind of like more or less like the market goes up again, the situation is stable again. So I see that more like a selling opportunity because I expect some more volatility to come down the road. And also it's partly because end of last year, just after the election, I met a New York-based billionaire. So he's founder of a fund manager based in New York. So he, of course, like all New York billionaires, probably know each other. So he knows Mr. Trump. He said that the one kind of like let's say fault in him is that he's a little bit like dyslexic, so he doesn't actually read that well. So basically, what that means is that he gets all of his information from like watching television, from Fox News. Then he stays late at night. He tweets something in the morning, and then his like assistants tell him that maybe this is not a good idea. So, but this is kind of like more like so. Of course, I could talk about inflation and other things, but it's kind of like more like my view is that more like boils down to this one thing. You have to understand how he thinks, and the like kind of like the most important thing is when you look at him and the other like U.S. presidents. So he doesn't want to be the president of the free world. He wants to be president of the United States of America. So his kind of like goal is to make America great again, as he has said, and also all his actions are more or less towards that goal. So he doesn't want to help like Europe build up their defenses. He wants to get U.S. troops out of Europe and so on. So which is basically what he wants to do. So that's kind of like my 5 cents on this matter.
Thank you. Mr. Rashad Rzayev, welcome again. Next question was for you. As a representative of Sovereign Wealth Fund, could you please tell us a little bit about your investment philosophy? And also, do you have an exposure in this region, Central Eastern Europe? And how do you navigate capital markets at these days?
Thank you for your question, Nilgün. So I'd like to start by mentioning that as a sovereign wealth fund, SOFAS has multiple missions. First of all, we are a savings fund, which means we try to kind of preserve and accumulate the capital that we get from the sale of national oil and gas for current and future generations. So By doing so, we try to maintain the fair and balanced distributions of resources over time. Our second function is about economic stabilization. As you know, stabilization funds transfer capital to the state budget on annual basis and play a key role in country's fiscal map. So by doing so, SOFAS acts like kind of a sovereign buffer or rainy day fund to mitigate the shocks caused by commodity price volatilities or general disruptions in capital markets. And our third function is about developing the economy in Azerbaijan by financing the important strategic and social projects. Among these projects, my favorite one is the state program on education abroad, and I'm proud to say that I've also got my master's degree thanks to this program, along with 5,000 Azerbaijani students, and the program is still ongoing. So on your question on our investment philosophy, it's based on our risk tolerance, which takes into account our liquidity needs and long-term horizon. We try to follow a disciplined approach based on our investment policy and investment guidelines approved by the supervisory board. And we constantly monitor markets, especially during these turbulent times. And as a long-term investor, instead of making like large strategic shifts, we try to make small tactical steps within each asset class that we have. Our portfolio currently is close to $65 billion US, and it's pretty well diversified, especially predominantly being invested in fixed income and public equities. Like 15 years ago, we started to add alternative asset classes like real estate, private equity, and infrastructure to our portfolio. And the main reason behind this action was, of course, diversification, return enhancement, and inflation protection in some cases like real estate or infrastructure. So our exposure to Central and Eastern Europe is around $600 million US, which is roughly 1% of the fund. And like it's predominantly invested in fixed income securities. For example, in our fixed income portfolio, we take some steps to overweight or underweight some countries compared to their benchmark. And in CEE region, we overweighted like Poland, Slovakia, and Bulgaria in that regard. We also have some indirect exposure to the region through our private managers. For example, in private equity space, we invested in sectors like information technology, communication services, and financial sectors. And we also have some renewable infrastructure and real estate projects in Turkey, Hungary, and Czech Republic, and also Poland. So to sum this up, SOFAS is a truly global investor. I mean, in each asset class that we have, we try to follow a global strategy. For example, in public equities, we try to follow MSCI World Index. In our fixed income portfolio is also invested across major currencies in the world, and in alternatives as well. We also try to follow some globally recognized private benchmarks. So we do not place any concentrated bets to any particular country or region. Instead, we try to remain like globally neutral, especially across developed countries.
While you are around here, we need to convince you more to invest Turkey more, huh? Thank you, thanks a lot. Mr. Toni Iivonen, we saw that this global risk appetite has been shifted lately from US assets to other developed countries, assets and currencies also. And do you think US dollar is losing its safe status? And what will be the new destination for investors going forward?
Well, that's a good question. Of course, kind of like the US dollar has traditionally been the reserve currency of the world, and most of the trade, especially with regards to strategic resources, has been done by using US dollars. So of course that has given it a special status. Now it seems to be that, of course, there's like many drivers which have been kind of like driving the US dollar downwards against the euro or a basket of other currencies. Of course, it's partly to do with budget imbalances, the burgeoning debt load, and so on, and also partly to do with Mr. Trump and his policies. But it's kind of like a little bit a tricky situation because currently the foreign investors own about $30 trillion worth of assets in the US, of which around half is invested in equities and the other half in fixed income. Fixed income part is, I guess, split between treasuries and corporate fixed income instruments. And the biggest investors to the US are China, Japan, the European countries, and so on, which of course, so there's different drivers for different investors, of course. For example, take Japan. So now they're actually experiencing some inflation, which they haven't been doing for many years, which is pushing up their like long-term treasury yields. For example, 30-year Japanese treasury yields around 3%, 40-year 3.5%, and of course it's in yen. So for example, Japanese pension funds, insurance companies, and so on might see those as attractive, especially because now, partly because of like weakening dollar, the yield in yen terms is not that attractive anymore, especially if because if you look at like market action a couple of years back, so dollar has been strengthening, now it's weakening, so it's weakening your return as well. Now especially if you're a fixed income investor, you need to think about hedging. That will eat up your return even more. And then it might mean that, for example, Japanese or European investors will repatriate some of that money back to their own countries, will invest in like German bonds, Japanese bonds, whatever. And that has a kind of like a downward pressure on the dollar, in addition to for example, this debt situation. So Moody's just downgraded the US debt, and the other agencies have been downgrading the US even before. And so there's all kinds of these like, let's say, headwinds in place with regards to the dollar. And my expectation is that, for example, if you look at it against the euro, so it will at least move back towards its like long-term average, which is 1.18 or 1.20 or something like that. Of course, the announcement yesterday, which was that the U.S. Trade Court said that Mr. Trump cannot actually decide on tariffs. So of course that strengthened the dollar. So let's see how that pans out. But going forward, so I advise you to kind of like look at other currencies. For example, Swiss franc has been performing well. Yen might start to perform quite well quite soon, especially if they start to repatriate some of the assets from the US. And also kind of like, of course it's not part of everybody's portfolio, but gold has been performing quite well also. So that's kind of like what you can, so you can diversify away from dollar, and I guess some people are doing. And of course that also generates some downward pressure on the currency rate.
Thank you. Thanks a lot. Burak Bey, at our new world, we are seeing economic power, consumption, innovation. Many things has been slightly shifting from Western area to Eastern parts, such as Middle East, Asia. Do you see any investment opportunities? I'm sure you're saying that. What type of investment opportunities seeing at your area?
Thank you very much for the question. And before going to that, I would like to comment on Toni's. Just he mentioned the trade courts. decisions. So besides economics, macroeconomics, internal politics, international politics, now we have judiciary as well coming to the game. So we might see much more levels of volatility. We'll see interesting times. Yes, as you mentioned, power is shifting from the West to Asia, and this is not a recent last 1 or 2 years development. It's a decades long development actually, and started in 1990s. If we check the growth rates of the Asian countries and compare it to the US or EU countries, we see enormous differences. In 1990s and years before 2000, we saw nearly double-digit growth rates in China and in other neighboring countries. India as well can be added to that. And on the contrary, we see merely 2 annual averages, I'm mentioning, just 2% or below 2% growth rates for the Western counterparties. So if we combine it, the compounded effect actually of those growth rates resulted in what we are seeing now. We are with trade deficits now, trade deficits accumulated on one side and trade surpluses accumulated on the other side, and we are discussing how to get out of it. Yes, this is the phenomena led by China, India, especially in the industries of artificial intelligence, electric vehicles, telecommunications, all the components of renewable energy industries. And there are some countries in our region, especially in the Middle East, doing their homework in advance, like Saudi Arabia, like Emirates, UAE. We all know the ambitious project of NEOM of the Saudis. We are reading that total investment expenditures will reach up to $1.5 trillion. And again, we know the ambitious projects of the Emirates renewable energy investments. Yeah, they are taking the advance, and we will see the investment coming from especially the Asian countries to our region. And coming back to your first question in the panel, CEE countries, the countries I mentioned, including Turkey, will be getting investments. It's my view from the Far Eastern and Southeastern countries rather than the Western countries. One example of Turkey I can mention. Historically, Turkey's FDI is coming from basically from EU, basically United Kingdom, Germany, France, Spain, Italy, and the United States. And the share of the Asian countries are actually really slow. And the share of manufacturing exports of Turkey within its the high-tech manufacturing exports share in total manufacturing exports of Turkey around 4.5%. But the OECD average, where Turkey is a part of it, and many developed countries are a member of this organization, is around 20%. So there's a gap. And if we take into account the trade war situation basically between China and US and the trade surpluses, it's logical to expect investments coming from Eastern countries to refill this gap, especially on high-tech sectors in our region, CEE and Middle East. And to sum up, I can say that yes, we may not be agreeing with the methods that the U.S. International politics is dealing with the situation. Either we call it protectionism or neo-mercantilism, whatever we say. But everybody in this room or everybody in the world agrees that there has to be something done, and the deficit problem should be fixed in the end. Hope it's not last so long. And the countries who have a better positioning in this war, let's say, will be in a relatively better position, and in my view, the CEE countries are sitting in a better position.
Thank you. Last week in Hong Kong for business trip, I mean, I saw that energy changes the wealth over there. They are quite eager to invest more. So that's a different part of the world, yeah. Thank you so much. Mr. Rzayev, last questions for you. As the head of Alternative Risk Management Division at SOFAS, could you please describe the challenges that you may in this area, the challenges that you face?
Yeah, sure. Thank you. Well, I'd like to start with the general understanding of what it means to manage the risks of alternatives. Well, in traditional asset classes like fixed income or public equities, the risk management process is still challenging, but it's more straightforward compared to alternatives because they are highly liquid, because you have real-time market data and you have lots of benchmarks which might be customized in many ways possible. But this is not the case for alternatives because alternatives are, as we all know, highly illiquid. They are privately negotiated and they are very unique. I mean, they're heterogeneous. So this makes the process of the risk management much more challenging, and there are certain reasons which make it like inherently more challenging. First of all, valuations are not observable in the market, and the data that we get from different private asset managers, they are first of all delayed, and they are also they are also like inconsistent across different reports. So it makes it hard to have kind of a helicopter view on all the portfolios. So and eventually it leads to the situation when we cannot make the data-driven decisions, which is very important nowadays. The second issue which I would like to discuss is the benchmarking. As I said, in traditional asset classes we have lots of benchmarks, but again this is not the case for alternatives. In private equity, for example, many people use public proxies to benchmark their investments, public proxies like MSCI World or S&P 500, but they do not capture the true liquidity risks of private assets. They do not capture the J-curve effect of those investments. I'm sorry for getting a bit technical, but I'm pretty sure that the audience here is quite familiar with the matter. So.
Sure.
So when talking about these issues, the data, the valuations, and the benchmarking, overall it makes it harder for us to kind of conduct a comparative analysis across different managers, to have, as I said, the helicopter view on all portfolio, and to set the realistic return expectations. So what we do at SOFAS to overcome these issues? First of all, we started to explore and invest in systems that consolidate and normalize the data that we get from different managers, so we can see them under a single umbrella, kind of. And it's pretty easy to do when you have small portfolio, but when you have portfolio of like thousands and thousands underlying assets, it becomes much more challenging, and also it brings a significant amount of operational risk. Second, what we do is that we also explore and subscribe to international private data sets. And I would like to note that compared to 10 years ago, those data sets become much more granular and detailed, which makes the process of benchmarking a lot easier. And the third, which is very important, we are in constant discussion and cooperation with other sovereign wealth funds, other limited partners like ourselves, and other private asset managers to be aware of recent trends, recent directions, and best practices in that field. And I would like to specifically note that this conference, where we have the opportunity to meet with so many professionals and practitioners from the asset management field, adds great value in that regard. So to sum this up, like, the risk management of alternatives is not about estimating volatility, but it's more about like navigating this complexity and uncertainty and information gaps over long time horizons. There is a well-known saying in our field that the risk management of alternatives is more art than science, and I think it's true, it's definitely true, because in order to do this effectively, you need not just sophisticated tools, but you also need to have better and more granular data, complete benchmarks, and of course you need to be in constant discussions with other key players in that field. Thank you.
Thank you. Thanks a lot. Thank you all for all sharing this valuable information and insight with us. Thanks a lot. And dear audience, we met your expectation to hear risk and opportunities in the specific region. And thank you for listening us.